Volkswagen's decision to halt vehicle production at its Dresden Transparent Factory, the first time the company has stopped production at any German site in its 88-year history, is the headline symptom of a much deeper stress test on both the firm and the German economy. It's a direct outcome of the low demand in China and Europe, and Trump's U.S. import tariffs. Volkswagen and its management say the move was painful but necessary, with Volkswagen brand boss Thomas Schaefer admitting the decision to end vehicle production at the transparent factory after over 20 years was not an easy one to make. It was, however, absolutely necessary from an economic perspective. So in this video, we will have a look at in detail why Volkswagen closed its factory in Germany, how it will affect German people, and what it means for the German economy. Let's first understand why Volkswagen has stopped production at its German site for the first time in 88 years. The company citing as some of the main reasons behind closure of the German site are of weakening demand in China and Europe, a painful hit from U.S. import tariffs as Volkswagen has warned tariffs could hit as much as €5 billion off results in 2025 and booked a roughly €1.3 billion operating hit in Q3, and the need to free cash for a roughly €160 billion 5-year investment program. The Dresden plant itself has been small by Volkswagen standards, producing under 200,000 cars since 2002. Yet its closure signals an operational reset that follows a wider restructuring agreement made with unions in December 2024 to cut up to 35,000 jobs in Germany by 2030, measures that already include about 25,000 employees who have agreed to partial retirement or severance, and management claims of around 30% cost reductions at key German sites such as Wolfsburg, Emden, and Zwickau. Economists and analysts interpret these steps as both symptoms and amplifiers of broader problems. Analysts quoted in Reuters and the Financial Times say the move exposes how high European energy and labor costs, slow EV price economics, and ferocious Chinese competition have hollowed out formerly protected margins, while commentators in The Economist warned that closing factories will not be enough and that Volkswagen needs far larger structural change to remain competitive. How will it affect the German people and the German economy? The immediate impact on German people will be felt by workers, suppliers, and local communities tied to Volkswagen's production footprint. Employees at Dresden face redeployment, early retirement, or redundancy, while many suppliers operating on thin margins lose contracts, creating knock-on effects for logistics firms, services, and municipal finances. German macroeconomists point out that the direct effects on employees, suppliers, and local tax bases will be material in regions like Saxony, where a plant closure ripples out through parts makers, logistics firms, and services, and that if Volkswagen shuts down additional capacity, the multiplier effects could widen, feeding into already weak GDP growth, regional unemployment, and strained municipal budgets. For ordinary German households and workers, the immediate impacts are straightforward and painful. Nationally, economists warn that further plant closures at Germany's largest carmaker would add to a protracted industrial adjustment that has already contributed to the country's sluggish growth story. Germany was one of the weaker major economies in recent years, and a further loss of manufacturing capacity would subtract from exports, investment, and middle-income jobs that underpin consumption. At the national level, Volkswagen's production halt reinforces Germany's broader industrial malaise. Manufacturing has already been dragging on growth, and further capacity reductions threaten exports, investment, and well-paid middle-class jobs that support consumption. Analysts note that each major plant closure can eliminate thousands of direct jobs and many more indirectly, shaving fractions of a percentage point off GDP growth in the short term. While Volkswagen plans to repurpose the Dresden site into a research and technology campus with about €50 million in joint investment with Dresden Technical University, economists caution that R&D roles cannot fully offset the loss of mass manufacturing employment, meaning the social and economic adjustment for workers and communities will be prolonged. Have Trump tariffs led Volkswagen to close a factory in Germany? Volkswagen's decision to stop production at its Dresden factory was primarily driven by structural problems in the global auto industry and in Germany itself: weak demand in Europe and China, intense price competition from Chinese electric vehicle makers, high energy and labor costs in Germany, and the expensive transition from internal combustion engines to electric vehicles. These factors alone were already putting heavy pressure on Volkswagen's margins and forcing the company to look for cost reductions and capacity cuts. However, Trump-era tariffs and renewed U.S. tariff threats did play an indirect role by worsening Volkswagen's financial and strategic environment. Volkswagen has significant exposure to the US market, and tariffs on imported vehicles and components increased costs, disrupted supply chains, and reduced profitability. The company has warned that US trade measures could cost it up to €5 billion in 2025, and it has already reported tariff-related hits to operating profit. This erosion of earnings reduced the cash Volkswagen had available to subsidize higher-cost German plants, making marginal sites like Dresden harder to justify. Trump's tariffs acted as a financial stress multiplier rather than a single trigger. They tightened global margins at a time when Volkswagen was already under pressure from electrification costs and slowing demand, accelerating management's decision to cut excess capacity and reallocate investment. Economists quoted by Reuters and the Financial Times emphasized that while tariffs alone did not cause the closure, they accelerated restructuring decisions by making global production more expensive and uncertain. Can Volkswagen shut down more factories in Germany? Yes, Volkswagen can shut down more factories in Germany, and it has not ruled out doing so. Management has repeatedly warned that some German sites could become obsolete if costs are not reduced and demand does not recover. Under restructuring agreements reached with unions in late 2024, Volkswagen aims to reduce its workforce in Germany by up to 35,000 by 2030, with around 25,000 employees already agreeing to early retirement or severance. The company also aims to achieve approximately 30% cost reductions at major sites, including Wolfsburg, Emden, and Zwickau. The company has also indicated it may reduce German production capacity by hundreds of thousands of vehicles by 2028. Economists say further closures remain likely if competitive pressures persist. Still, they warn that doing so would deepen the economic and political fallout, increasing unemployment, weakening supply chains, and intensifying pressure on the government to intervene with industrial subsidies or cost relief measures. Volkswagen executives frame potential future closures as a last resort to restore competitiveness, yet analysts argue that without broader policy support to lower energy and labor costs, the risk of additional shutdowns in Germany remains real. The company's publicly stated ambition to reduce annual German capacity by hundreds of thousands of vehicles by 2028 and to find €4 to €10 billion in savings across the brand means further rationalization is possible if demand does not recover or tariff pressures persist. The macroeconomic cost would be meaningful. Independent economists estimate that each large plant closure removes thousands of direct jobs and multiples more across the supply chain, raising local unemployment rates and reducing household spending, which in turn can shave tenths of a percentage point off national GDP growth in the near term. Financial markets also watch these moves as a barometer of Germany's industrial health and competitiveness, and persistent plant shutdowns would likely depress investor confidence, weigh on corporate investment, and increase political pressure for industrial policy measures such as subsidies, regulatory easing, or targeted tax relief. Thank you for tuning in, and I encourage you to subscribe to our channel for fresh content on crucial global matters. Additionally, please like the video and share your insights on the topic in the comments section below. Have a wonderful day.